On the Money Show, we make sure that we don't just talk about investing in mutual fund, but also help you meet the brain behind these funds. In this week's Meet Your Fund Manager segment, we have on board Avnish Jain, who is the head fixed income at Canara Robeco AMC, and he's the fund manager of Canara Robeco's banking and PSU debt fund since August 2022. Avnish, good evening and welcome to the show. We are going to
Good
talk
evening.
about banking and PSU debt fund today. That's in news a lot these days. But then let's begin the conversation by understanding the concept of this kind of a fund category. So banking and PSU funds are debt funds that lend only to banks and public sector companies. The high quality of borrowers allow these loan means there is risk of default which is involved is comparatively very less. However, they do get affected if the interest rate in the economy go up. You can answer this question later on. Before that, I want to understand the portfolio allocation currently that's there in the fund.
So, as we run the banking PSU debt fund in line with the regulations, 80% plus of the fund is in banking names, which can either be bonds or CDs, or we have investments in public sector undertaking PSUs or public financial institutions. The rest 20% is broadly probably in some high quality HFCs, housing finance companies, high quality NBFCs, and obviously there is some portion which is investing in GSECs as well, because there is a liquidity portion which needs to be maintained. So that is the general portfolio allocation as of now.
All right, let's talk about the benefit or the current interest rate scenario that one might have if invested in this kind of a fund category. Could you explain us how beneficial would that be?
So from an interest rate perspective, I think now, obviously, as you were just talking about the banking crisis in overseas markets, which is impacting the Fed policy direction or the policy function, we are likely to see probably a slow Fed day after tomorrow. And probably RBI could also go slow depending on the evolving situation in the banking sector overseas. In terms of rate policies, we don't expect any major slowdown in rates or rate easing happening in the near term. So currently, in terms of banking PSU debt, we are focused around 2 to 5 year kind of maturity papers, which can give you moderate duration and also a good pickup on carry. Of course, if you look at yields, 2 to 5 year yields are practically in a range of 760 to 780, which is a pretty flat curve. But we do want to have some duration in the fund. So that is how we see the interest rate scenario. In the near term, we don't see a major, I would say, any market will remain volatile. So there is no anticipation of rate cuts. But yeah, if situation worsens on the banking crisis, anything could happen. So we will be prepared for that as well.
Avnish, talking about the fund portfolio now, because the exposure is to very high credit quality issuers and low credit risk profile included, do you think the portfolio is more on the conservative side, which in turn is a very safe option for investors to park in their money?
Absolutely. Comparison to a normal fund, which could have an option, I would say, an option to invest in low rated credits as well. Banking in India, obviously, as we know, PSUs are public sector undertakings, which are owned by government, which are considered quasi-sovereign. So from that extent, it is safer than other funds, because 80% has to be invested in, minimum 80% has to be invested in banking and PSU or PFIs. So to that extent, yes, it is safer than other options. And it provides investors a good way to invest in a conservative fund.
What is the kind of approach that you've actually taken when it comes to risk management, your sector limitations, and also the liquidity?
Yeah, so obviously the three main risks in mutual funds or in debt funds are interest rate risk, liquidity, and credit risk. As we have discussed, credit risk is much lower in this one. From an interest rate risk perspective, you can manage it via duration. In terms of liquidity, as we know, SEBI has obviously put in some regulations having minimum 10% in liquid assets like cash or T-bills or G-SECs in any fund. On top of that, we obviously, like I said, we have G-SECs, G-SEC government bond positions in the fund. PSU bonds are the most liquid bonds in the current market scenario, especially when you are looking only at AAA PSU bonds or PFIs. These are the most liquid. So in terms of, I think liquidity of banking PSU, I would rate it as one of the highest in all categories.
Avnish, now since these funds are called one of the safest category to invest into, why is it the right time to park in your money or to invest in them? Why should one make this particular fund or this category fund a part of their portfolio?
I think so. From a perspective of like we talked about, being restricted to invest in a few sectors which are considered safe, simply because one, we are talking about public sector undertakings, both PF and PFIs, which are owned by government and are quasi-sovereign, considered quasi-sovereign. Second is the banking sector is tightly regulated by RBI, and we will presume that it is much safer than any other companies, which they may be, or normal non-PSU companies, which may be riskier. To that extent, it provides comfort to investor and more confidence to invest without any apprehension that they may be could be big credit losses in this fund. So that is one factor. Second, we are seeing some distress in the market overseas, which could lead to slowdown globally as well as locally. So whenever slowdown happens in growth, there could be some pressure points in some sectors outside of banking or PSU space in other companies, and that could lead to some credit pressures. So for an investor currently considering that current situation, it's a good option for investors to be sticking to safety and earning good returns on their investments.
But then what should be the park-in duration? Now, considering if we are to assume that the interest rate rise scenario is almost to peak out, or you think because of the banking crisis that we are seeing right now, this might just extend a bit more, what should be the ideal duration to be invested in this particular fund? I mean, 3 years is the minimum time that you should be giving it to.
Yeah, so definitely from a taxation perspective, 3 years is a good time horizon for investors to look at. Also, what we would likely see, one scenario could be that rate after peaking in probably next 1 or 2 months, remain on the pause mode for next 6 months, 8 months as inflation trajectory is looked at and see how it goes about. Probably by next year, mid or somewhere, you start seeing a rate cut cycle or somewhat the start of that. So a 3-year period would be a good option for investors to hold on and invest in this fund. So typical duration could be 2.5 to 3 years for this fund. And we are slightly lower right now because we feel that there is still some leg room left for rates to go higher, especially on the corporate bond side. But I think more or less we are at the end of the rate hike cycle. So we will eventually increase the duration to the appropriate level.
Avnish, how are you selecting your security, in terms of the rating involved? Because see, now here is something about the banking sector that's an understanding or an explanation for investors and our viewers. Looking at the current global or more specific, the US banking crisis, how would you explain the Indian Act being on strong grounds to handle any such situation? Also, because the fund has debt tools of public sector companies and top performing banks, what is the risk associated?
So from our from Canara Robeco perspective, we have been always very careful on credit for a long period of time, and we continue that philosophy. So as of now, I can say that we are fully invested in AAA assets, either be banks or PSUs or PFIs. So our portfolio is fully AAA, but yes, there is options to go a little lower on the curve. So the risk, I think, emanates from the rest 20% where fund manager could invest a little on the lower rated side, and there could be risk there. But overall, from our perspective, like I said, our philosophy is to invest in the highest rated credit as of now. And we continue to hold to that philosophy, investing in AAA assets. So our portfolio is AAA and will continue that for some time. We don't see as of now moving down the credit curve anytime soon.
All right, let's talk about the Indian scenario of interest rate rise. You think that a pause is needed right now, or only once now in a day or two we have the Fed also coming up with their announcements? It's only then we will also get a roadmap for our interest rate announcements?
So definitely, I think things have changed a lot in last 10 days. Earlier, I was of the view that 125 basis probably is the one which will happen in April, and probably after that, RBI will pause. But all the banking stress scenarios, and we have seen in US as well with Europe, there is pressure on banking sector, and there would be some sort of transmission of very high rates will happen now, and that could lead to Fed being a little bit slow, because you want to also protect the financial stability in the markets. That is another factor which the central banks will look at. The swiftness by which most of the banks have been supported by most of the central banks, either directly or through other large banks, clearly shows the anxiety and level of stress which has been there. So clearly, central banks don't want a repeat of 2008. And though in last week, I think ECB did hike by 50 basis, pointing out to that there is enough tools to manage any stress. But yes, Fed would slow down, likely slow down to 25 basis in this policy, and probably could hold. Now you are seeing some stress in the banking sector, and monetary policy operates through the banking sector. So all the credit growth happens through banking sector. And because of any problems on capital and all, if the credit growth slows down, that helps the Federal Reserve to manage the inflation. So I think probably Fed could do 25, and depending on what unfolds over next 2 to 3 weeks going into April, I think there is a good chance that RBI could also pause.
If we have to evaluate the rising interest rate scenario for the US, despite of so much hike, we have not seen inflation coming under control or anywhere close to the comfortable mark of Fed. So do you really think this interest rate hike is going to help in a few quarters?
I think this is the first time in probably 30, 40 years that the rate increase has been so fast. So generally, the interest rate hikes do take 12 to 18 months to filter in through the system. And I think this is the first instance where we are seeing some pressure on banking system. And I think going forward, probably there could be more full transmission of rate hikes, which has happened close to 5% now. And I think by the year end, obviously, the expectation is that rate to fall to probably around near more 4% handle rather than 2% handle. But yes, that will also drive the Fed policy. So it depends all on how inflation definitely trajectory is for rest of the year. But I think these few tremors which have now emerged in the global markets, that could propagate the disinflationary kind of pressure in the system.
Exactly. More questions on this, but then before that, I want to understand, talking about the fund that we are discussing on, what all actually goes in the cost of investment of these funds?
Cost of investments meaning
from an investor's point of view?
Cost of investment is only the fees that is paid for the fund manager management fee which is paid. So there is a fees which is there, or a part of the fund which is there, and that is the cost to the investors.
Risk appetite investors need to have to be invested in these kind of funds?
Sorry, I could not get the
Any
full question.
particular objective or risk appetite one should have if one wants to look towards this category?
I think this fund is good for a for a conservative investor, and I think considering anybody who also wants to look at a fund apart from looking at fixed deposits, this is a fund where you do invest in high quality banks issuances as well as public sector PFIs or public financial institutions. So it's for a conservative investor who is just probably dipping his legs in mutual fund market. This is a good fund for that. As it is from a risk perspective, credit risk perspective, it is probably one of the safer ones.
Apart from this particular category, if at all one wants to have an exposure in any other category of debt fund, the strategy can be from short to medium, or can one go towards medium to long term also?
Again, good question. So I think it depends on the investors. I would say knowledge in the market, because investor who is just stepping into the market, for him a short duration fund or a banking PSU fund is a good fund to go with. For investors who have been in the market for some time and they know the nuances of the debt market, for them entering into a long duration fund at this juncture also could be a good point, good entry point. And market should peak out in next few months, and then after that probably it will remain in a pause mode, but over 12 to 18 months, one could get good capital gains because it could be expected that rates would come down. So in that scenario, I think only for investors again who are well informed about debt markets and know all the risks of duration, they should step into medium to long duration funds.
All right, Avnish, thank you so much for being on the show and helping our viewers
Thank
with
you.
all the aspects of banking and PSU debt fund. On that note, we'll take a quick break and